day friends. In the lecture series on retirement planning, we are discussing some important and popular retirement plans. In my previous lecture on retirement plans, I talked about two plans which are being offered by the Life Insurance Corporation, that is Life Insurance Jeevan Nidhi Plan and the Life Insurance Jeevan Nidhi Plan and Life Insurance Jeevan Akshaya plans. In this lecture, apart from talking NPS, in this lecture I will be starting with SBI Life Saral Pension Plan. So, this plan also aims for the future retirement planning of the individual, retirement annuity of the individuals. So, it's a single premium. Single premium means payment can be made in lump sum money. So, it's a single premium individual non-linked non-participating pension plan which provides immediate annuity. That is, you pay a lump sum money, immediately your pension annuity will start, right? So, especially supposing you attain a particular age, and at that age you want that you deposit a sum of money and regular monthly installment or regular payment should come to you for meeting out your expenses. So, this scheme is suitable for those persons. So, why I am saying it is a single premium, non-linked, but is not linked to the fluctuations in the market of the financial instruments in which the SBI will invest. Suppose the SBI invests in the equity market, the debt market, in other financial instruments. So, the fluctuations in the value of that investment is not going to impact the annuity which the individual will get, the monthly income which the individual will get, right? That's why we call it a single premium individual non-linked non-participating pension plan which provides immediate annuity. It is like a traditional pension plan which provides regular income to the policy holders, right? So, it is not being impacted by the fluctuations in the value of the financial instruments. Guaranteed income payout with return on purchase price, right? I deposit a crore of rupees, 1 crore rupees, that I will get a guaranteed payout on a regular basis, right? Irrespective of the value of the investment which the SBI has made out of that investments. So, loan and surrender facility available for financial emergencies, right? Supposing the minimum age to buy the plan is 18 years and the maximum age is 65 years. So, what are the benefits of SBI Life Saral Pension Plan? Number one, it's a secured plan that provides financial independence to live a happy retirement life. I invest a money and monthly guaranteed installment, or I would say monthly income I'll be getting out of that, right? So, it is irrespective of the fluctuation in the market, the value of the investment that is being made from my investments, right? From the corpus of the fund that is being created by the SBI, the value of that corpus keeps on fluctuating. But since the SBI gives a assured return, that is a minimum return. Suppose at the time of taking a plan, a person is being assured that 7% return is assured. So, irrespective of the rate of interest in the market, irrespective of the equity market scenario or the debt market scenario, that money will be guaranteed to the person who buys the policy, right? So, financial independence, live a happy retirement life. Reliability provides regular income to take care of the expenses. As I said, a payout is guaranteed, annuity monthly payment that is to be offered is guaranteed, right? Protection, it provides protection by adding optional riders in the policy. As I said, it can be, you can take a loan out of it, or you can even liquidate it, means you can take the money back if any emergency arises. So, there are optional riders in this policy. So, other than the SBI, there are many corporate sector, corporate houses also. One important house is HDFC Life. HDFC Life is a famous life insurance company in this country, right? So, HDFC Life Click 2 retirement plan there is a plan for the retirement planning which is known Click 2 retirement plan. It is a unit linked pension product. The moment I say unit linked means units will be purchased, and from this units the investment can be made in the equity market, in the debt market, depending on the type of product you have bought or the mix of these two, that is partly equity, partly debt, depending on the risk profile of the person who buys the policy. So it's a unit-linked pension product that helps to plan early to achieve retirement goals. Friends, these days, people who are working in the corporate sector, the private sector, there is too much work pressure. So what they plan is they start their job in the age of say 25, 20. They want that at the age of 50 itself, they should get retirement, right? And they want to invest in such a manner so that from in the age of 50, it's just an example. I mean, there's no age limit which I'm prescribing. I'm saying you want to retire in the age of 50, you want to retire in the age of 55, whatever your likings may be, right? So you want that during your working life itself, you create such a fund and you buy that, you make such investment that when you want to retire, at the time of retirement, you should get a regular flow of income. Even before the age of 60 or before the age of 50, you want to retire in the age of 50 itself, right? So this type of plans can be purchased. So no entry charges, no premium allocation charges, no policy administrative charges, and no exit charges. That is, whenever you buy these type of plans, normally a lot of administrative charges are there for the company, for the organization which is managing the fund. But under this HDFC Life Click 2 retirement plans, right, at the time of entry, there is when you allocate money, no charges being charged, policy administrative charges not being taken, and when you take exit from this plan, even no exit charges are being levied on the individual who buys this policy, right? So it is a benefit. So the retirement plan can start from rupees 2,000 per month. So as low as 2,000 rupees you can invest and you can buy a retirement plan. The minimum age to buy is 50 years and the maximum is 65 years, right? So it means any individual between the age of 18 to 65 can buy this HDFC Life Click 2 retirement plans. Maturity starts as early as 45 years to 75 years. As I was saying, that those people who want to retire in early age, as early as 45. Nowadays, I was saying that in the corporate sector, especially in the people who are working in the private sector, there is a lot of work pressure and they want that they should work 20 years and they should accumulate that much fund, right? So that in the age of 45 itself, you want to retire. So you can take this plan in the age of 45 itself, right? Or you feel that in the age of 45, even if you don't retire, but in the age of 45, your children will be grown up, and at that point of time, you will be needing money for their higher education. A lot of expense will go in their higher education. So at that time, you need a regular flow of income other than your salary income or other than your regular income of your business or your profession, right? So you can buy these type of plans so that a monthly income can come from that money, right? So maturity age starts as early as 45 years to 75 years. It secures the retirement with assured vesting benefits and also gain from upside in the market. Because since it is a unit-linked plan, under the unit-linked plan, the investment is being made by means this HDFC will make investment in the equity market, debt market, depending on the terms of the policy, right? So you get the benefit of if there is an upside in the market. So if the value of your investment goes up, you are also being benefited out of that. So thereby ensuring a market linked return also. So there is a minimum guaranteed that, okay, say for example, in present scenario, I can say the rate of interest which you can get even in banks is 6 to 7%. So the HDFC will say 6% is a return which is guaranteed. And then apart from this 6%, whatever the value of your investment will be, if it is higher than the 6%, you can get the benefit of that also. So this is the benefit of this HDFC Life 2 Click plan. So death benefits to the nominee, which will be higher of the fund value of the policy at the time of death, or 150% of the total premium paid till the death of the insured. Suppose the insured dies. In that case, the benefit, the nominee of the insured will get the money, which will be minimally the current value of the fund or 105% of the premium paid, whichever is higher. Whatever the money I have paid so far, minimally 105%. I suppose up till this stage that person has paid say 60 lakh rupees. So 105% of 60 lakh rupees, that is 63 lakh rupees is the minimum guaranteed amount which the nominee of that insured will get. Or if the value of the fund investment is more than 60 lakh rupees will be there, then the higher of the two will be received by the nominee of the insured. Another scheme of the HDFC is HDFC Life Assured Pension Plan, right? Friends, there are hundreds of schemes. I am telling you only a few popular and schemes which are normally being taken by the people which have a good corpus of funds and which have a credibility in the market. I have talked about SBI plans, I have talked about LIC plans, I have talked about earlier policy of HDFC. Now it is HDFC Life Assured Pension Plan. It's a unit-linked pension insurance plan, ULIP, which offers loyalty additions, right? So it's again like previous plan of the HDFC. This plan is also of unit-linked. You buy units, where investment is being made in the markets, the instruments, financial instruments, which may be money market instruments, the treasury bills, the government bonds, and even the equity. So, another benefit is that if you continue for a longer period of time, you get loyalty additions. Loyalty addition in the form of pension multiplier every alternate year, starting from the 11th year, right? Minimum age to invest in the plan is 18 years and the maximum is 45 years. So, any person between the age of 18 to 45 can invest in this HDFC Life Assured Pension Plan. Limited pay and single premium pay option available in one product, right? So, either you can pay single premium, one lump sum money, or you can pay a limited pay on a regular basis over a period of time. Death benefits to the nominee, which will be higher of the fund value of the policy at the time of death or 105% of the premium paid till then. So, as in many of cases we have discussed earlier, that the minimum guaranteed which the SBI HDFC will offer under this is, that is the current value of the investments or 105% of the premium paid, whichever is higher, that money will be paid to the nominee. It offers several benefits which include tax benefits, single or limited payment option, right? Means when you invest through this, you get a tax benefit also. Apart from the HDFC, there is another insurance company that is known as ICICI Prudential, ICICI Pru, popularly known as ICICI Pru. So there is a retirement plan of ICICI Pru also, which is known as ICICI Pru Easy Retirement Plan. Friends, all these plans are more or less similar. There are certain features which are being added, or there are features of each of these plans. The idea of telling you these plans is that these are the popular plans which are available depending on the need, depending on the credibility, depending on your likings. Any of the product or plan you can buy. You can buy LIC plans, you can buy SBI plans, you can buy HDFC plans, you can buy ICICI Pru plans, right? So this plan is known as ICICI Pru Easy Retirement Plan. It is again like HDFC 2 plans which we have discussed. It is again a unit-linked pension plan which provides regular annuity payout post-vesting, means investing, so that there is income provision after retirement. That is, in a particular age when you start up to a particular age, let's say for example 55 years or 60 years, and then after that you get an annuity of income. The policy does not allow partial withdrawal, right? Under this policy, you can't withdraw partial amount. Guaranteed death benefits are 105% of the total premium paid, right? Suppose a person dies during the time of this plan itself, right? So at least whatever the value of that investment may be at the time of the death of the deceased of person, right? In at least minimally 105% of the total premium paid will be given to the nominee. There are two types of investment options under this policy. One is easy retirement balanced fund. When I say balanced fund, you invest in both equity as well as debt instruments, right? So money is invested in mix of equity and debt to ensure balanced return. The other can be easy retirement secure fund. Money is invested in a mix of debt, money market and cash investments to achieve a balance between protection and return. To guard it from any unforeseen market falls, thereby adding to savings. So what you are noticing is that in the easy retirement balance fund, the investment is made both in equity as well as in debt. But in the easy retirement secure fund, the investment is not made in equity but only in money market instruments, right? Money market instruments where the investment is made for a very short period of time, right? The government bonds means liquid bonds where any time liquidity can be made, which are of very short period of investments, like call money market. You must have heard these terms, which are for a very short, we call it money market instruments. Money market instruments where the investment is made for less than a year normally. Normally, there is no time period rule as such, but normally the investment is made for 3 years, 6 months, 1 year, right? So these are called money market investments. So in the easy retirement secure fund, the instruments are where the money is being invested is money market instruments, the cash investments, the debt, right? So these are considered more safe, right? The fluctuations are less here. So there are two schemes: easy retirement balanced fund and easy retirement secure fund. The other plan, which is again by the private corporate sector, is Reliance Smart Pension Plan. It is a non-participating unit-linked pension plan that allows to save systematically and build up a huge lump sum amount to provide regular income after retirement, right? So for 10 years to 30 years, the minimum range is 10 to 30 years. For 10 to 30 years, you keep on depositing on a monthly or quarterly or yearly basis, depending on how you want to invest the money. And after that period, you get a regular flow of income for a particular period of time. So the policy terms ranges from 10 to 30 years. The person within the 18 years to 65 years can invest in the plan, while vesting period is between 45 to 75 years. Vesting period means where you can withdraw the money, means 45 you can get an annuity that, okay, now in the age of 45 years, you start in the age of 18, and in the age of 45, you start getting a regular flow of income, depending on your terms and conditions for which you have bought, the period for which you have bought. Top-up premium can be paid at any time. Suppose I am making an investment of 25,000 rupees per month, but I want some top-up premium. I got some 1 lakh rupees from somewhere, so I want to deposit this money. That is called top-up premium. So I can add some money in that. So loyalty additions of up to 9% are given in this scheme and added to the fund value, which begins from the end of the 6th year of the policy. So there is a loyalty element in it. As the time period increases, you get a loyalty addition in this, right? So 9% additional loyalty benefits will be given from the 6th year onwards. On death, higher of the fund value or 105% of the total premium paid is returned to the nominee. See, most of these schemes which I have just narrated, these I have talked about, right? In this, minimally the value of the investment or 105% of the premium paid is a minimum guarantee. Under this also, the same is the case. And this also scheme also enjoys the tax benefit. So tax benefit on investment and on return under Section 80C of the Income Tax Act 1961. The other scheme name is Max Life Guaranteed Lifetime Income Plan, right? Is again, Max Life is also one of the important insurance company in this country in the private sector, right? So it is again a non-linked annual traditional plan which provides a guaranteed flow of income to the insured even after the retirement. The minimum eligibility to invest in the plan is 50 years and the maximum is 80 years. So from 50 to 80 years, you can keep on in this age group, you can invest. The people of this age group can invest in this, right? income payout on a yearly, half yearly, quarterly or monthly basis as per your needs and requirement of the policyholders, right? So once you invest the money, now the money which you need means that after all these are all retirement plans, you want that a corpus is being created and from that a regular income you should get. So in what intervals you want to get the money? It may be yearly, it may be half yearly, it may be quarterly, it may be monthly, depending on the needs. You want that every quarter you should get X sum of money. So the payment will be made, the payout will be made on a quarterly basis. You want regularly every month you should get the money. So the scheme can pay you on a monthly basis also. So guaranteed income as long as policyholders is alive, right? So you invest the money and throughout your life a guaranteed income will be given to you. With deferred annuity variant, after the death of the annuitant, nominee will get minimum 105% of the purchase price of the policy. Suppose the person dies. In that case, the nominee of the person will get minimally 100%, 5% of the purchase price of the policy. So other than this of the corporate sector, that is the LIC, the SBI and the HDFC, this ICICI Pru and the Max Life, there are especially certain government schemes, especially to cater the unorganized sector of this country, the unorganized workers of this country, whether it is street vendors, sabji wala, your rickshaw puller, and all these type of people, right? So we call it, they are working in the unorganized sector or the gig workers, we call it, right? So for them also there are many schemes of the government of India so that they can also have some retirement plans. So few pension scheme launched by the government are, like I am naming a few, not all. Pradhan Mantri Shram Yogi Man Dhan Yojana, popularly known as PMSYM scheme. That is Pradhan Mantri Shram Yogi Man Dhan Yojana. The other is Atal Pension Scheme, right? These all schemes have been launched during the last 10 years. Pradhan Mantri Vay Vandana Yojana, PMVVY, Pradhan Mantri Vay Vandana Yojana. Employee pension schemes. So let me discuss first these first 2-3 schemes. One is Pradhan Mantri Shram Yogi Man Dhan Yojana, PMSYM scheme. So this is a voluntary and contributory pension schemes. When I am using voluntary, means not compulsory to join everybody, right? Any, especially to cater to the unorganized workers, any unorganized worker can join it voluntary, and it is a contributory. The worker has to contribute a month, and the government of India will also contribute in it. So this is a voluntary and contributory pension scheme to ensure old age protection for unorganized workers. See, people who work in the corporate sector, people who works in the government sector, they get a corpus of fund at the time of retirement, right? But people who work in the unorganized sectors, right, they don't get some corpus of fund once they attain the age of 60 or once they attain the age of a retirement age, so-called retirement age, right? They work throughout their life. So, but time come when you are not incapable of working, your working age group, finishes, I would say, right? Or you are not able to work, you are not able to earn. In that age, in that stage of your life, it's become difficult for you unless you have some supporting income. So keeping that in mind, especially the unorganized workers, this scheme was being started by the government of India. So the unorganized workers mostly engaged in home-based workers, street vendors, midday meal workers, head loaders, cobblers, rack pickers, domestic workers, washermen, rickshaw pullers, laundry laborers, agriculture workers, construction workers, right, handloom workers, leather workers, audio-visual workers, and similar other occupants whose monthly income is rupees 15,000 per month or less and belongs to the entry age group of 18 to 40 years. So friends, basically what the scheme is? A scheme is people who are in the age group of 80 to 40, and since it is a contributory scheme and working in the unorganized sectors, right, this scheme has been started by the government. So Pradhan Mantri Shram Yogi Man Dhan Yojana is a contributory pension scheme on a 50-50 basis. That is 50% the contribution will be made by the person and the 50% contribution will be made by the Government of India, right? Where prescribed age specific contribution shall be made by the beneficiary and the matching contribution by the central government. So what are the benefit of this PM-SY scheme? So it provides you minimum assured pension. Each subscriber under the PM-SY scheme shall receive a minimum assured pension of rupees 3,000 per month after the attaining of 60 years, right? So once you contribute a particular sum of money up to the age of 60 years, after the 60 years, throughout your life, till the time you will remain alive, right, 3,000 rupees per month will be contributed by the, given by the Government of India as a pension under this scheme. And not only this, but even there is a family pension. Family pension means if something happens to the person after the age of 60, his or her spouse will also get the money, not children, spouse only, right? So during the receipt of the pension, if the subscriber dies, the spouse of the beneficiary shall be entitled to receive 50% of the pension received by the beneficiary as a family pension, right? So when the both of them are alive, 3,000 rupees, if the person dies, that person who has contributed this under this scheme, right? Person dies, the spouse of that person means if there is a male, the female is his wife, or if there is a female, then the male counterpart, her husband, will get a family pension, right, which is 50% of it. The family pension is applicable to the spouses only, right? So what are the benefit? Exit and withdrawal. If a beneficiary has given the regular contribution and died due to any cause before the age of 60 years, his or her spouse will be entitled to join any and continue the scheme subsequently by the payment of regular contribution. They can continue with the regular contribution or exit the scheme as per the provision of the exit and withdrawal. So means even if a person who has purchased this policy, who has contributed to this policy, if anything happens to that person before the age of 60, right, the spouse has the right either to contribute to continue the scheme or can exit also, right? So friends, this is about the Government of India's very popular pension scheme, which is known as PM-SY scheme. So under this, in this lecture, friends, we have talked about some of the schemes which have been started by the Government of India, and some plans which have been started by the corporate sector, and especially the life insurance policy company like LIC, like Max Insurance, ICICI Pru, HDFC Life, and even the SBI. There are certain plans, and these are all popular plans which are normally beneficial for the policy holders. So these plans you can suggest to the people who are subscribed. As a student of financial planner, you can suggest to the people who are making retirement planning, and even in your own life you can purchase any of these plans as per your requirement. Thank you very much.